Let's start with your word of the day. It's taught. Now, what's taught right now in your mind?
Well, we're looking at the market in a couple of different ways that are frankly colliding in a way that makes us more concerned about the action going forward over the next quarter or so. What's taught in our opinion is how stretched and narrow this market has become. Now, that's been a storyline for some months, even quarters now. But we have more, in our opinion, risk on the horizon from a fiscal standpoint, geopolitically. Also, from an earnings standpoint, there's opportunity, which also brings downside risk potential as well. So we're looking at these markets as stretched between, new all-time highs. We made 4 new highs during a government shutdown, where the fiscal problems are really thrown in our face on a daily basis. And also where gold is making new highs and moving in a direction that looks parabolic at this moment, which is telling two totally different narratives of risk and optimism simultaneously, which makes us concerned about the direction going forward.
All right, so a bit concerned, but it sounds like you are seeing some opportunities in the market. We hit on this earlier. When it comes to tech, the earnings estimates have increased over the last couple months. If you look, since July, the earnings estimates have increased for 3 sectors. It's communication services, tech, and financials. Is that kind of a roadmap to where you think investors should put their money, where the earnings estimates are growing?
Sure, we were at the same position coming into last earnings season, and frankly, what we saw was a display of incredible income statement resilience on the part of U.S. corporations in a way that really justified some of the valuation, particularly with the larger, higher growing corporations that had earnings and cash flow that fulfilled the optimism that the market was carrying with it. Right now, at this part of coming into another earnings season, we're at that precipice again to where we have to see follow through of evidence that earnings and cash flow can justify the valuations that we've seen, particularly among the cohort of the largest names that carry the most weight in the larger indices. Now, that broadening, I think, is good from a macroeconomic standpoint. Financials is kind of the engine that keeps things going, so broadening optimism on the part of financial, especially larger banks, definitely bodes well for just broader macroeconomic growth here in the U.S. But we've seen, that broadening go out to industrials, also some consumer spaces, that makes us really optimistic about where things could head in this next earnings season as well.
You're mentioning the consumer, which is going to lead me to your pick. As I mentioned earlier, Bank of America out with some research for the week ending October 4th. Total card spending was up over 2%, but when you look at airlines, it pulled back about 1.5%. Lodging was flat. Your pick for us today is Delta Airlines. Are you worried at all about the strength of the consumer, the strength of the labor market hitting that airline and the entire travel and hospitality sector?
Sure. If things are taught from a broader market standpoint, with valuations being stretched, also stretching risk for hedging and looking at the price of gold, we want names that exposure to our clients that have a little more margin for safety. And a name like Delta Airlines has that. We feel like this part of the cycle that we're in, this air pocket of demand and supply mismatch that we saw this summer seems to be largely in the rearview mirror. And Delta has a valuation of 8 times forward earnings, 10 times forward cash flow.